Hi everyone, welcome back to the channel. Today we are breaking down depreciation, what it is, why it matters, and how it affects your financial statements. So whether you're in class or self-studying, stick around because by the end of this video, you'll understand it clearly. So let's get into it. What is depreciation? Depreciation is the loss in value of a fixed asset over time due to wear and tear, usage, age, obsolescence, or you could say outdated basically. So basically with this with depreciation, what we dealing with is that sometimes every time when you buy an asset, the asset is going to decrease in value as years go by because wear and tear, because you know that cars can get damaged, and and the more you drive it, it will get wear and tear. Usage, the more you use it, the more it loses its value. Age, obviously, if you're gonna have a car for 5 years and you bought it for like 1 million, you basically can't sell it for 2 million. You have to sell it for less than that because it's an old car at that time. Then outdated, or outdated meaning also same thing as age, that these days people want to buy cars uh that just came out like just a few years ago, but not from 10 years ago, obviously. So that's the reason why your asset is going to actually lose value. Now, in accounting, we basically record depreciation to reflect the true value assets over time, right? We're trying to reflect the true value assets over time because remember, since we do know that it cannot keep the same value in the years, it needs to keep on decreasing. So we need to keep on making sure that we know the value of that asset with time. And also, we have to spread the cost of the asset over its useful life. We need to know uh, its cost, since this is accounting. So we need to know the cost for us to actually be keeping that car around, right? We also need to match the expense to the period in which the asset is used. So meaning that we need to keep up with the depreciation. As it depreciates, we need to make sure that we know the value by actually knowing what depreciation has accumulated for it, right? Now, let's look at the method for actually doing or for calculating depreciation. There are two methods of calculating depreciation. The first one right now that we'll be looking at, it is the straight line method. So now, with the straight line method, what happens is that your car or your asset is just going to decrease each and every year by the same amount. So meaning that if the depreciation for the first year was 15,000, it's going to be 15,000 for the second year, third year, fourth year, up until its value gets to a certain amount. So here we have the first one, which is the formula is what? Depreciation is equals to what? The cost that we bought it for minus the residual value, right? So the residual value is basically the value that it's going to have at the end of its useful life, right? Then after that, we divide it by its useful life, which would be in years, right? So if we were to do an example right now, if we bought a car for 300,000, if we bought it for 300,000, and after 5 years, the car is basically going to have a residual value of 50,000. So after 5 years, it's going to have 50,000, right? So then you also have to divide it by 5. So there you do see that you're going to have 250,000 divided by what? Divided by 5. And obviously, we do know that now that depreciation is going to be 50,000 per year, right? So meaning that from when it is bought up until it's up until uh, it gets to a value of 50,000. It means that for that 5 years, each and every year, the car or the that asset is going to depreciate by 50,000 rands. All right, I hope that that example makes sense right there. So always make sure you remember that when it comes to straight line method, it means that each and every year it's going to decrease by the same amount. So another example here, we have that the equipment is 100,000 rands. The residual value is 10,000. Remember, residual value, it's the value that it's going to have after its useful life, right? So it's going to be 10,000, then the useful life is 5,000. So if you use the formula there, we have the 100,000 minus the 10,000 divided by 5, which is the useful life. Then each and every year, it's going to depreciate by 18,000 rands. All right, so that is the first one. right? So with this one, if you can see carefully, we were dealing with it when you were given a residual value. Now let's look at it as if when now it's not going to have a residual value. So in other words, what he's saying is that after that useful life, it's going to have a value of 0 rands. But in accounting, you cannot have a value of 0 rands. It needs to at least be 1 rand. At most, it needs to be 1 rand. So it cannot be zero, basically, or cannot be a negative value. All right. So now let's look at the other method of a straight line. But now this time around, we are given the percentage now. So now, here's the example now. The example says that a business purchases machinery for 120,000. So obviously, if it purchases it at 120,000, that is going to be our cost. Then they tell us that the depreciation is calculated at 10% per year using the straight line method. So this one is basically going to just be the rate, right? So just make sure that you also note those things down there. Now, when it comes to depreciation, now when it doesn't have a residual value, you're going to use the formula cost times depreciation rate. All right. So as you can see here, we have the 120,000, which was the cost, and it is multiplied by the rate there per year, which is 10%, and it's going to give us 12,000 per year. So it means that each and every year up until it gets to its useful life, it reaches its useful life, it means that now it's going to get to a value of 0. So meaning that each and every year it's going to depreciate by 12,000 rands, right? So meaning that it's going to lose value each and every year by 12,000 up until it gets to its final value, right? Up until they decide to sell it, basically. Then now we look at the second method of calculating depreciation, and that one is called the diminishing balance method, right? The diminishing balance method. So now, with the diminishing balance method, now this is when now our depreciation is equals to what? Our book value. Be careful. The other one, we use the cost value, but with depreciation, we're going to use the book value. Keep in mind of that part. I'll explain what the book value is shortly. Then we're going to multiply it by the depreciation rate, right? We're going to multiply it by the depreciation rate. Now, then that means, as I was saying now, that our book value now is going to be what? It's going to be the cost price minus the accumulated depreciation. So sometimes you will see in accounting that a car might be bought in 2015, but now you'll be dealing with books or you'll be dealing with records that are in 2018. So already the depreciation, it has already depreciated for the 3 years before from 25, 26, 27, 28, right? So to go into 26, 27, 28, which my bad. No, sorry. My bad. Sorry. So it basically, if you bought the car in 2015, right, and you're dealing with accounts for 2018, you know that obviously it has already lost value, right, because it depreciated from 2015 up until 2018. So obviously for that 3 years right there, that depreciation that it got in that 3 years, that's basically what you call accumulated depreciation. And the reason why um we need to subtract the cost price by it because we are looking for the book value. We are looking for its value at that year so that we can calculate the depreciation on that very specific year. Because when it comes to the diminishing balance, it's not the same as the straight line because the straight line, if the first year's um depreciation was 15,000, the second year is going to be 15, 15. But with diminishing, as time goes by, the depreciation decreases, right? Because the value keeps on going down and down and down and down, right? So you'll see as we continue what I mean by that. So now here's an example, right? The example says that the asset that we bought now it costs 100,000 rands. Then now the depreciation now is 20% per annum. So for the first year, which is year number one, obviously for year number one, it doesn't have any accumulated depreciation because it is still new. It's still the first year, right? So for year number one, it's just going to be the cost. That cost is going to be its book value multiplied by the 20%, which is the depreciation rate, and that will give you 20,000 rands, right? So meaning that on that year, which is the first day, it's going to depreciate or lose value of 20,000 rands. Then now we go to year two. So year two now, this is when this formula will come handy now. Because now when it comes to the book value, as you can see, the cost price is 100,000. But obviously the year before, it has accumulated a depreciation of 20,000 rands. So meaning that we need to subtract 20,000 rands from it so that now we can have the book value. So we can have the value that it certainly has when it enters year number two. Then obviously we're going to multiply it by the depreciation rate and it gets to 16,000 rands. And as you can see, like I said, the depreciation in diminishing balance, it always decreases with time because at first it was 20,000, now it was 16. Then the next one is going to be less than 16,000 rands. All right, I hope that makes sense right there. Right. So now, as I said here, right, this method gives higher depreciation in early years. So meaning, when it's still starting, right, it's gonna give high depreciation, but now as time goes on, it's gonna have a less depreciation value, right? Because you can see it as 20, then 16, then after it's gonna be less than 16, might be 15 or 14, right? But certainly it's literally going to be less than 16,000 rands. Right. So looking into the last slide, obviously, which is the summary and the tips that I'm going to give you when it comes to depreciation. First one is that the straight line, I'm sorry, then add the straight line, but the straight line method has the same depreciation amount every year. So meaning that each and every year, the depreciation for a straight line method is the same, right? So don't forget, if the first year was 15,000, the second year is going to be 15,000, third year is going to be 15,000 up until its useful life, right? Then now, the second tip I'm going to give you is that the depreciation for the diminishing balance method, it decreases each year. The depreciation for the diminishing balance method, it decreases each year. So meaning that if first year it was 50,000, the second year now it's going to be less than 50,000. Let's just say, for example, it moves from 50,000, 50K, then for the second year it becomes 40K. Then obviously for the third year it's going to be less than 40K. It might be 38K up until its useful life, right? So that's basically how this works. Then now what the last one I would say is that depreciation is a non-cash expense that reduces the asset value. So always remember that depreciation is non-cash. There's no way that somebody can say that they paid depreciation. No, no, no. It's basically a non-cash expense that literally just reduces the the asset value, basically, right? Then now, another huge tip out of them all is that you must always show your calculations clearly in exams, right? Don't miss steps because if you miss steps, you definitely are going to miss marks, right? So yeah, and with that, that's a wrap on depreciation. So if this video helped you, don't forget to like, subscribe, and hit the notification bell so that you don't miss the next accounting topic. If you've got questions or a specific chapter you'd like me to cover next, drop it in the comment section below and keep learning, keep growing. I'll see you in the next one.